You've built an absolute juggernaut in high-margin specialty care. You've got this sprawling global footprint, industry-leading intellectual property, and a rock-solid path to hitting $80 billion in revenue by 2030. On paper, you were doing everything right. Yet, the market looks at your business right now and decides to heavily discount it. Well, that's the exact paradox currently surrounding AstraZeneca. There is this massive, unavoidable tension right now between the underlying cash-printing fundamentals of their oncology and rare disease engines and a very loud, very real regulatory crisis unfolding in China. So today, we're going to look at the numbers, look at the panic, and figure out if the market is totally missing the forest for the trees.
Here is the undeniable proof that something strange is happening with how this asset is being priced. Historically, if you look over the last 10 years, AstraZeneca has traded at an average forward price-to-earnings multiple of 18.3x. Today, it's sitting compressed at 15.5x. Look, for a company that just grew its core EPS by 18% at constant exchange rates in its latest quarter, a multiple contraction of this magnitude screams one thing: the market is pricing in a severe systemic risk. But to figure out if that fear is actually rational, we first need to understand how this company truly makes its money today.
Section 1. The economic engine. We are looking way beyond legacy pharma.
Because honestly, this is no longer the sleepy primary care business of the 2010s. If you're valuing AstraZeneca based on its older cardiometabolic drugs, you're literally looking in the rearview mirror. When you break down the revenue for the first half of 2026, where they brought in $15.38 billion, Oncology is now the undisputed king, making up 46% of the pie, which is $14.1 billion. Biopharmaceuticals sits at 36%. And then you have rare disease, driven mostly by their brilliant integration of Alexion, contributing 16%. The true economic engine of AstraZeneca today relies on highly complex, hyper-targeted therapies operating in massive total addressable markets. Just to put it in perspective, the global oncology market alone is projected to expand to over $833 billion by 2035.
It's really a tale of two portfolios right now. On one hand, you have the past, legacy primary care. Drugs like the blockbuster Farxiga, which actually just saw a 19% drop in H1 2026 revenue down to $4.0 billion. Why? Because it lost U.S. exclusivity in April 2026 and is now facing fierce generic competition in places like Japan and China. I mean, that's just the nature of pharma, right? Patents expire. But on the flip side, you have the high-margin specialty future. Assets like Tagrisso and Imfinzi, which grew 6% and 27% respectively. These drugs have IP exclusivity extending deep into the 2030s. They are actively replacing the revenue lost to generics with higher margin, incredibly defensible revenue.
So, the absolutely crucial takeaway here is that AstraZeneca has built a fortress around this new revenue. Their economic moat is incredibly deep. First, you've got that intellectual property exclusivity on Tagrisso and Imfinzi. Second, you have extreme switching costs. Think about their rare disease drug, Ultomiris, which generated $2.6 billion in the first half of 2026 alone. If you're a clinical specialist or a patient stabilized on a complex biologic regimen for a severe rare disease, you refuse to switch to an alternative because of localized clinical risks. It's just too dangerous to mess with what works. And finally, they have unmatched global commercial scale, operating across 125 countries. Smaller biotech firms simply cannot replicate that kind of distribution footprint.
Which brings us to the central conflict, the market's concern.
And hey, real quick, if this kind of research-first analysis is your thing, you'll probably want to subscribe. Okay, so if the moat is that strong, why the massive discount? It boils down to severe regulatory friction in their second-largest market. In late 2025, Chinese prosecutors formally indicted AstraZeneca's Chinese subsidiary, along with its former executive vice president and China head, Leon Wang. The charges are heavy: medical insurance fraud, unlawful collection of personal data, and illegal smuggling of oncology medicines like Imfinzi and Enhertu. The core of this data violation allegation is that local commercial teams were allegedly altering the genetic testing results of lung cancer patients just to make them eligible for the drug Tagrisso. AstraZeneca has already prepaid $3.5 million to Chinese customs for unpaid taxes, but they've warned they could face legal fines up to $17.5 million.
Now layer that China crisis on top of broader macro headwinds, and suddenly the bear case sounds incredibly smart and very concrete. You have the Farxiga loss of exclusivity we talked about. You have the U.S. Inflation Reduction Act, or IRA, where price negotiations for the first 10 selected drugs took effect in January 2026, creating structural limits on how pharma can monetize new drugs. And you have a balance sheet where net debt rose to $26.9 billion in the first half of 2026, which means higher finance costs in a high interest rate environment. The market is looking at all of this and asking a very fair question: is the growth story fundamentally broken?
Let's look at the evidence, specifically the Q2 2026 earnings. To figure out if the growth story is actually broken, we have to look at the ledger. And this number right here is a direct counterpunch to the bears, 6.05%. That is the positive surprise in Q2 2026 core earnings per share. Analysts expected $2.48, AstraZeneca delivered $2.63. What this proves is that despite the noise in China, despite the IRA, and despite generic erosion, the profitability of their specialty mix is exceptionally strong.
Let's look at the broader Q2 2026 reality check. Total revenue hit $15.38 billion, up 6%. The core gross margin was a staggering 83%. Most importantly, CEO Pascal Soriot reconfirmed their full-year 2026 guidance, expecting total revenue to increase by a mid to high single-digit percentage. When those numbers dropped, the market breathed a huge sigh of relief. London Stock Exchange shares actually closed up 1.72% at £128.88. Their strong execution in oncology and rare disease completely absorbed the pipeline setbacks and patent cliffs.
Now let's step back and look at the quality scorecard.
Because, numbers only tell us what happened yesterday. To understand if this is a durable compounder for the long term, we need to shift into a qualitative analysis of the business's fundamental health. This is our fundamental quality scorecard, and the blended score sits at an exceptional 8.5 out of 10. What's driving this? Well, look at management alignment, scoring a 9. Executive compensation is structurally linked to long-term equity growth. CEO Pascal Soriot's pay is driven heavily by deferred bonuses and long-term share awards that have a 5-year vesting cycle. They literally win when shareholders win over the long haul. Market position is a 9 because they hold leading global market shares across key targeted cancer segments. And profitability is a 9, highlighted by a massive 34% core operating margin. So this isn't just a revenue growth story. It's a high-efficiency cash generation story.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. Now, if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Premium also includes Portfolio Watch to monitor your portfolio and flag important changes, and Insider IQ to track meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Moving into our 5-year scenario framework. Before we dive into the math, I must explicitly state this is a hypothetical framework for thinking about possible outcomes to 2030. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios.
We've mapped out 3 probability-weighted scenarios for how this could play out over the next 5 years. At a current price of £128.88, our blended probability-weighted target sits at £179.09. But keep in mind, that target requires very specific operational execution from the company, not just the valuation multiple magically expanding back to its historical average.
Let's break down the base case, to which we assign a 50% probability. For this scenario to become reality, AstraZeneca must successfully achieve its stated Ambition 2030 of $80 billion in total revenue. They must also expand their core operating margin slightly to 35% through manufacturing efficiencies. If they do that, and the market rewards them with their historical 18.0x exit PE multiple, the implied share price reaches £184.53. That bridges directly to a 53.66% implied 5-year total return, which is nearly 9% annualized. Now, the bull case, which is driven by massive success in their new oral GLP-1 weight management drug, could push revenue to $90 billion for a 110% return. Meanwhile, the bear case, where revenue stalls at $70 billion, leaves the stock basically flat at roughly £117.
But what breaks the thesis? Let's talk about risk analysis.
So what brings that bear case to life? What are the early warning signs investors actually need to monitor? First is clinical trial volatility. AstraZeneca's pipeline-focused model is inherently exposed to late-stage failures. We literally just saw this in July 2026 when the Wanhua Cardio-T-Transform trial failed in ATR cardiomyopathy. If we see a string of these, that $80 billion ambition dies. Second is a structural, permanent compression of the core operating margin below 30%. And third, connecting right back to our central tension from the beginning.
If China's volume-based procurement price cuts, which by the way recently slashed prices by 20% to 30% on older drugs, start severely deteriorating targeted oncology volumes amid this ongoing legal scandal, that right there is the biggest threat to their international margins.
All right, let's bring it all together. The bottom line.
We opened this explainer by asking why a high-margin juggernaut was trading at such a severe discount. Well, here is the final synthesis. The market is intensely, almost exclusively, hyper-focused on near-term headwinds, the Farxiga patent cliff, the macroeconomic pricing caps from the IRA, and particularly those headline-grabbing compliance investigations and indictments in China. They are pricing in the fear of the moment, but the actual numbers from Q2 2026 show a completely different underlying reality. The 83% gross margin and the 18% core EPS growth prove that AstraZeneca's structural pivot toward oncology and rare diseases is successfully and profitably offsetting those legacy losses. That $80 billion revenue ambition remains fully intact. So the real question you have to ask yourself is this: will the broader market wake up and realize this massive discount before the China crisis resolves, or is this pharmaceutical giant destined to stay undervalued? If you want the full research, including the deeper framework behind this explainer, you can get it free at StockSentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.